Hey everyone, and welcome to AI Explains ICT. In this video, we're diving deep into some absolute gold from ICT's core content, specifically Month 5, Episode 2. We're going to tackle one of the most nail-biting questions every trader faces. When the market smashes through a key level, is it about to reverse, or is this the real deal breakout? Let's unpack the framework that'll help you spot the difference. All right, so picture this. It's a scenario we've all been in, right? The market hits a really big, obvious high, and that's the moment of truth. You're sitting there asking yourself, okay, is this a real breakout where we're going to keep pushing higher, or is this just a classic stop hunt designed to trick everyone before it slams back down? The big question is, how can you possibly know? Well, according to ICT, the secret to figuring this out lies in a concept he calls open float. Now, what is that? It's actually pretty simple. Think of open float as the grand total of all the pending buy and sell orders that are just sitting there, waiting to be activated, both above and below where the price is right now. So this open float isn't just one big blob. It has two very distinct sides. You've got buy-side liquidity above the market. That's basically a big collection of buy stops. And then below the market, you've got sell-side liquidity, a pool of sell stops. The best way to think about these, they're like powerful magnets, constantly pulling the price towards them. Okay, so where does all this buy-side liquidity actually hang out? Well, ICT is super specific about this. It tends to pile up right above recent short-term highs. Like last week's high or last month's high, but the really big pools, the ones that matter most, are sitting above those major swing points. We're talking the 3-month high, the 6-month high, even the 12-month high. Trust me, these are the exact levels that smart money has its eyes on. And then, of course, you've got the flip side, sell-side liquidity. It's pretty much a mirror image of what we just talked about. You'll find huge collections of sell stops building up below short-term lows, like the weekly or monthly lows. And, yep, just like the buy side, the really juicy pools of liquidity are waiting below the lowest low of the last 3, 6, or even 12 months. Just knowing where these key levels are, that's step one. All right, so now we know where the liquidity is. But what happens after the price finally hits one of those major pools? How in the world do we figure out what the market really wants to do next? This is where ICT gives us a fantastic framework. He tells us to view the price action that follows as a battle for control, a liquidity tug of war, if you will. Okay, to make this whole idea crystal clear, nothing beats a real example. So let's walk through a case study together. Take a look at this daily chart. See that really obvious, significant high that formed up there? And then look way down below. See that major low? The entire story we're about to unpack happens right between those two key points. Now just watch the price action here. The market grinds higher for months, and you can see its ultimate destination, right? It's heading straight for that pool of buy-side liquidity, all those buy stops just waiting above that old high, and then bam, price punches right through it. That right there is the liquidity run. But the million-dollar question is, what happens now? Okay, pay close attention, because what happens right after that liquidity is taken is absolutely critical. And look at that. We get our very first clue. The market sweeps the high, and then almost immediately it turns around and breaks a recent short-term low. This is a huge deal. It's a classic break in market structure, and it's our first real sign that the sellers might be taking control. Okay, now let's watch the reaction. After that first little drop, the buyers try to fight back. They try to push the price up again. But just look at this rally. It's so weak, it completely fails to gain any real ground. It doesn't even get close to challenging that high we just took out. That, my friends, is a massive sign of weakness. And now let's look at the other side of this tug of war. Compare that weak little rally to the drop that comes right after it. Wow. You can see the difference, right? Price just collapses. It moves down with real force, easily smashing through the prior low and carving out new territory to the downside. It's pretty obvious who's in charge here. The sellers are just completely overpowering the buyers. So let's just take a quick pause here and ask ourselves the question. Based on everything we've seen so far, the big run on the high, that weak attempt to rally back, and then that powerful drop, who do you think is winning this tug of war? Who's really in control of the market's direction right now? I mean, the evidence is pretty overwhelming, isn't it? Every single time the market tries to rally, it's weak and it just gets sold off immediately. By the way, in institutional lingo, this is what they call distribution. But on the other hand, every drop has real power behind it, real conviction, and it successfully chews through more and more sell-side liquidity. And this side-by-side view really just hammers the point home. It makes it so clear. On the left, you've got the buyer's best shot, a weak,
failed rally. And on the right, you see how the sellers respond, with a powerful, decisive drop that prints a new lower low. The imbalance of power here, it's just night and day. And just like that, the mystery is solved. The run on that major high, that was the initial objective, but now the reversal is officially in play. This pattern of behavior, repeating over and over, is basically the market screaming its true intentions at us. It's telling us exactly where it wants to go next, down to that big pool of sell-side liquidity we identified earlier. So how can you use this in your own trading? Well, it breaks down into a pretty simple four-step process. First, you've got to identify that run on major buy-side or sell-side liquidity. Second, you have to carefully watch the market's immediate reaction. Third, and this is the key, you analyze the tug of war. Ask yourself which side is actually gaining more ground. And finally, step 4, you take all that evidence and use it to form a really high probability directional bias. And really, this is the ultimate goal, isn't it? As ICT puts it, when you master this kind of analysis, it gives you prognostication for having smart money perspectives and an institutional vantage point with all of your trades. You're literally moving beyond guesswork. You're learning to read the story that the market itself is telling you, price bar by price bar. So I really hope this breakdown of open flow and the whole liquidity tug-of-war concept was helpful for you. If you got some value out of this video, do me a favor and hit that like button and make sure you're subscribed to the channel. Oh, and if you have any questions at all, just drop them in the comments below and a real human will get back to you.
All right, that's it for this one. Until next time, safe trading.